Granite Shares introduces two new ETF funds, and they're called Auto-Callable Income Strategies. One is the Tesla Yield Boost ETF, and the other one is the NVIDIA Yield Boost ETF. Auto-Callable Income Strategies, we're going to explain it today in today's video.
Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we got a very interesting video. If you've been searching for high income or new ways of getting high income, instead of just jumping in straight into the extreme high risk to generate that high income, you've probably noticed a new category ETFs have been showing up lately, and they're called Auto-Callables. We've done a couple of videos on these when they first came out, and they're not traditional dividends, ETFs. They're not cover call ETFs. They're a totally new breed of ETFs that have been out. So this is not something brand new. These things have been out, but they're starting to get more and more popular as we go on. So in today's video, we're going to break down what auto-callable ETFs really are, how they generate their income, where the risk really lies, and if they're good or not good into a income-focused investors. Because the two we're talking about today are from Granite Shares. Their new NVIDIA and Tesla auto-callable ETFs. So we're going to break those down as well, kind of educate you with some new products, how the product works, and so on. Well, we first do a shout out to all of our Patreon supporters, all of our YouTube members. Thank you for supporting the channel financially. We appreciate you each and every day. And then we also want to say welcome to all of our subscribers back. And if you're not a subscriber, hit that bell notification. Don't be afraid to hit that subscribe button and join the community. Let's get into today's video.
The evolution of income ETFs. The traditional ETFs have relied heavily on covered call or high yield equity exposure. But in volatile markets, those approaches can struggle with capital erosion and inconsistent income. That's where auto-callable structures have entered into the ETF space, offering the alternative way to pursue income while explicitly defining the downside risk parameters. Investors' interest in alternative income strategies has grown rapidly during the volatile market cycles. Auto-callable ETFs are designed to seek regular income while incorporating explicit downside barriers, typically in that 30 to 40% range. The appeal is straightforward: income potential with rule-based risk management, but the mechanics matter. And you can see that the funds have grown well over $200 billion already invested into these type of ETFs. So what are auto-callables, you're asking? This is probably the biggest question I get. What are these? Well, an auto-callable ETF holds a laddered portfolio of structured notes. Rather than selling options directly, these notes are linked to the equity index or the single stock and are designed to pay contingent coupons based on predefined rules. Instead of relying on option premiums, income comes from a structured coupon payments embedded in the notes themselves. So the core component is what we call the coupon. The coupon is the primary income engine of an auto-callable structure. These coupons are typically higher than traditional bond yields, but they are contingent and not guaranteed. Payment depends upon the underlying asset remaining above a predefined barrier on observation dates. That means market stability plays a major role in income consistency. Now, the second core component is the barrier protection. Barrier protection defines how much downside the structure can tolerate before income actually stops. Most auto-callables use a 30% to 40% downside buffer. and it's checked on specific observation dates. If the underlying asset stays above that barrier, the coupons continue. If the barrier is breached, income pauses and the fund becomes exposed to the downside risk. So what happens after a barrier is breached? Well, one important distinction. Auto-callable income can resume if the underlying asset recovers above the barrier of future observation dates. It creates a path back to income. But during deep or prolonged drawdowns, distributions may be reduced or eliminated temporarily so that you don't keep digging a deeper and deeper hole like a lot of ETFs do. And that, that's called NAV erosion, and that's what we always want to try to prevent as much as possible. So this brings us to the next point. Granite Shares took their Yield Boost series and introduced two new auto-callable funds. And they apply this strategy to single stock exposures to NVIDIA and to Tesla. Now, these strategies aim to harness the volatility while defining the downside risk through structured barriers. The latter approach reduces the timing risk compared to single entry structures of the products. Now, another thing that happens, and I'll add this to this so you can understand, is that an auto-callable is a fund that can be called at any time once they've hit these certain categories. So if a NVIDIA takes off and has a huge upside, they can actually do a auto call on the fund and reset all their parameters. Okay, so when a fund is growing tremendously, they're going to auto call them and set up different categories for this thing to continue to generate its income. Okay, and the same thing, if it hits the bottom, goes too far down low, and I'll use Tesla. If Tesla drops way too far down, they can also, as I told you before, stop payments, stop their income, let it reestablish itself, or if everything hits correctly, they can do an auto-callable and reset their numbers. So it's a very interesting piece that they're using. So, like I said, Granite Shares applies the auto-callable framework to a single stock exposure of NVIDIA and Tesla. These strategies are aimed to harness the volatility while defining the downside risk. The Granite Shares auto-callables, NVDA ETF, and the Tesla ETF each hold multiple auto-callable notes within the staggered maturities. So that's kind of what I was just explaining to you, that they put in about 5 different callable notes, and they're staggered with different maturity dates. So as the date comes along, it drops off. They'll add new ones to it. The structure seeks to smooth income over time rather than relying on a single contract. Distributions are typically monthly, reflecting to the underlying coupon schedule. Now, these funds being out so new, there's not a lot of information that's out there. But what we want to start looking at right now, here's what we've already been able to find. As I told you already, I'm going to jump a little bit around here of the number of auto-callable notes already established, and that's the quantity of 5. These are the number of notes that are staggered that will continue to create that income needs, and they're all set at different levels. Okay, they'll set them at a higher, one at one level, one at a higher level, one at a, to continue the fund going up and up and up. So the average weight of the coupons are 17.83%. Now, if you look back at the earlier screen, the NVIDIA is actually they're looking to target about a 12% total return for their investors. And how they've done that, they've already used weighted average coupons of 17.83. So 5 coupons into 17.83% average. Now, the coupons, they're paying coupons 100%. This is the percent of the auto-callable that are above the coupon barrier. So these are different things that you're always watching. This is how you can check on one. If you see a coupon that's, falling below its numbers, it's falling below its pay side of it, you're going to see this 100% drop down to, 80%, 70%. And that's telling you that they have notes that are just not performing. The other one that you want to look at is how many of them are near maturity. Okay. So this is why I said these things are different. And some people will say, oh, this is very confusing. And it can be very confusing. Like options were confusing, puts were confusing. These are a new part of investments that we need to learn a little bit. And we're here to help you with that. So as a fund, as a note comes closer and closer to maturity, you'll see this number rise as well. So when you get to a higher number of maturity, then it's time to sit back and wait before you invest to see how they reset their notes. And you can see what the weighted average is across the board. Tesla, very similar, same thing. They are targeting a little higher. They are actually 14% target. And you can see that they have a weighted average of 20.23% in their coupon side of it. 5 coupons are already out there, and they're all above the, because they're so brand new, they're all above it, and none of them are close to maturity. Let me give you another case history. And this is the broad market auto-callable ETF, such as those as I don't know exactly how to pronounce this, but I'm going to call it Autocallables. It's the Auto-Callable. We covered this, honestly, probably about a month ago when this came out, when I said these are probably the future of what's coming in ETFs. Because why I say that is that really starts off with that barrier, because so many people have lost money with those weeklies and with all those new ETFs that have popped out. That's why this is starting to become even more popular of an old system coming out as a new design. CIAE total return versus the S&P, we call it Index 100. So it's the S&P 500, but they're really using about the 100 pieces of the S&P 500. And over the past 6 months, you can see the return has been 15.6 versus S&P 500's at 13.7. So the broad market Auto-Callable ETF apply the same framework and indexes just like the NASDAQ 500, the S&P 500 and the NASDAQ, and they're using the very similar that Granite Shares is using. So these strategies may perform relatively well in sideways or choppy markets where the barriers remain intact and the income continues. Okay, this is why these are becoming popular, because if we have sideways markets, choppy markets, we're in markets that we don't always know exactly what's going to happen. One bad news cycle, things start to go crazy. And these are where these funds are really paying off. And you can see the percentages that we're talking about of the growth and against the S&P 500, which is the benchmark with all ETFs. So now understanding the income risk. Okay, that contingent income. Well, the first thing I want to make sure everyone understands, auto-callable income is not guaranteed. Coupon payments are not guaranteed. If the underlying asset falls below the barrier, which is normally, like I said, that 30 to 40%, on the observation dates, income distributions will cease until they recover. So coupon payments depend on market conditions at that specific observation dates. In severe market drawdowns, income can pause entirely until recovery occurs. These strategies are not sensitive to large or rapid declines, but gradual moves. So I always put it more closer to these things are watching its NAV erosion for you. So if you have, you may have one that is, I always call it market cycles, that you may be having a fund that's $100 and it drops down to $70. Okay. Some people out there will call that NAV erosion. It's a market adjustment. Now, if the continuous over the next 3, 5, 6 months, you have that continuous drop off, now we're talking NAV erosion, and that's where these things kick in. They have predetermined observation points that they want to look and see what is the stock doing. It's almost like having your doctor check your blood pressure and check your A1s and all that. Is what are you doing over a long period of time? NAV erosion and distribution realities. All ETFs distributions are from NAV. Okay, that's the net asset values. The high payouts can reduce the share price if the underlying asset performance does not offset the distributions. So again, if a fund is paying out $10 of distributions each month and they're not generating that income through premiums, they will pull the money from the net asset value and to continue to pay your distributions. That's why essentially you need to evaluate your total return, not just your yield. Okay? Your total return is actually the whole key to every investment. How much money are they pulling out, putting you back? That's going to lower your total return. The more money they income, it's going to increase your total return. You should always be aggressively looking at total returns. Now on the chart up here, you'll see sustainable yields and return rates are around 0 to 5% is sustainable. Moderate will put you at 5 to 10. Aggressive will put you at 10 to 15. And high risk are 15 and above. So these are always areas that you want to take and look at your NAV erosion. The higher you go up the scale, the more potential you have for NAV erosion because they're shooting for such high level yields. Now, auto-callables versus covered call ETFs. Covered call ETFs benefit from elevated volatility, but often cap the upside. Auto-callables prefer price stability above a defined floor, trading upside participation for structured income and barrier protection. Each strategy responds differently depending on market regime. So, like I said, you look at the chart again. Auto-callable income yield is in the gold color. Downside protection is in the dark green, and upside potential is in the light green. And on normal cover call ETF, most of your part is made up from income yield. Auto-callables, little larger income yields, but a lot more downside protection. Okay? Between the two, I mean, yeah, some covered calls have a little bit more higher upside than the auto-callables do, but both seek high income, while auto-callables provide that barrier protection, while covered calls benefit from higher volatility premiums. So it really comes into what type of market are we really involved into. So who are auto-callable ETFs for? Well, right off the bat, I'm going to say auto-callable ETFs are not replacement to traditional equity investing. Okay? They may appeal to investors who understand structured products, are comfortable with contingent income, and prioritize defined downside frameworks. As always, suitability depends on objective. Okay, you have to look at your risk tolerance. You have to look at your portfolio construction. So, where it really comes to, and I'm going to put it to you in I always call Doug's layman's terms of making it easy to understand. If you are sitting here and looking at, I'll call the weekly payouts of Tesla or Nvidia, And you've seen your funds drop off dramatically. You're seeing big drop-offs across the board. The auto-callables may be in your best interest because you get that targeted yield of that 12 to 14%, depending on each fund, and you have that downside protection that you can almost know that the worst you're going to have, you can see it come down to 30% over a period of time. Now, we don't all want to lose money, and this is not guaranteed that, if it's below 30%, you get your money back. That's not true. What it's saying is that at the 30% downside, it's going to stop the income. It's going to do everything to recover itself, like we explained earlier. So these are pieces of, almost, they're partially into a hedging side of things. They're also into a protection side of it. The one I was explained to and how it came to me with, that if you are into, and I call understanding structured products like annuities where they're structured, these are what it comes into. It's kind of a mix between the two across the board. So to me, they're a great part for something that's in a questionable thing. And you can see Tesla and Nvidia both have a lot of volatility behind them in moving up and down. Let me know what you think about the new Granite Shares Auto-Callables. Leave a comment down below. Leave a comment down below if you understand or know how Autocallables, if you're comfortable with Autocallables, or if you need more information about Autocallables, we can do a bigger, deeper dive into this. We've done it now. This is probably our third video, I think, on Autocallables. They're just a little different of an ETF. Let me know in the comments below. We'd love to hear from you.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments